Good morning. This is Paula White. I am your instructional lecturer today for Accounting 102 lecture for week 2. So how did week 1 go? For week 2, just like Accounting 101, each week builds on each other. So let's see what we have in store for you today. Today's agenda, I'm going to go over again the resources and your options to get help, live help. Then the lecture, the instructional portion of today's agenda is Chapter 7. And then at the end of the session, I'm going to go over week 2 homework. What is it? What's expected by your instructors for this homework? And the big question is, how do I get started? So we're going to actually go over your homework for this coming up week that's due Saturday Mountain Time by midnight. So with that as our agenda, I noticed this week that a lot of folks fell into 3 different categories with my when I graded their homework this time. Some didn't submit anything, and I can only assume that if you didn't submit any work, that you are totally lost. And we're going to show you where some resources are, because we want you to succeed in this curriculum here at this university. Another group kind of are hanging in the middle between 50% and 70% correct. And I would kind of say that you're less confused, but you do have some questions. So the review of your resources is valuable today also. And then we have some people, or I had some people, who got like 100%, 99, 98, 97%. They're doing well. Even they should know where their resources are with those 1 or 2 little questions that stop them from mastering the subject. So please know that the range of the cohort ranges from 0 to 100%. But there's help for everyone at every level. Excuse me. First off, if you go to Shark, you should be familiar with Shark. If not, click on Shark from your home page, and then you get this familiar landing page. If you go to the 3rd one on the top row, it says the Student Success Center. Click on the Student Success Center. And if you want immediate assistance, you click this big box that says click here to enter the Student Success Center for immediate assistance. Then, if you're a first-time user, you click here from instructions on how to access and use this center. And it's pretty simple. And if you want specific help in a particular course, well, since this is Accounting 102, click on Accounting, the first one, first column, first row. And you'll see the accounting specialists within the Student Success Center staff and what their hours are. So check when the hours are, and then if you're clicking on at the time that they're open for accounting, click here to enter the Student Success Center for immediate assistance. So that's how difficult it is to get live tutoring help. Excuse me, I have a frog in my throat. I'm going to go back. So that's one source. The second source, which I think is the coolest thing, if you click on Live Session, there's a schedule. And this schedule changes every mod, but this schedule, the very first one, is the instructional lecture, which is exactly as you're used to. The instructor does the lecture, has interaction with the students who are on live. It is recorded and then shared for all other students in that same course, that mod, to be able to listen to the lecture and listen to it over and over and over again if they need to do that. So that's still what happens with the first lecture, the first live session in the schedule. What you ask happens in these other 5 sessions. Well, that's the cool part, because those sessions are not recorded, but they are manned by other instructors who are teaching the exact same course in the exact same mod. So they're in it with you, just like I'm in it with you right now. So let's say for example, Monday night, you pop in at between 8 and 9 Mountain Time. Pop in just like you popped in live to this lecture. And you're going to be welcomed by someone saying, "Hi, my name is so-and-so, and what can I do to help?" Because they're there for an hour to help you with your questions. So come with questions. We ask that you already review the lecture videos, and the link is right here, and those are 5, 10, 15-minute long lecture videos before you attend one of these sessions below, because it's set up to answer questions, but we need some base of knowledge on your part in order to have questions to be answered. So help us help you, and actually go to the lecture videos. I'll click that live link now just to show you what it looks like. And these are the mega course lecture videos. And they are very effective, but they're not an hour long. At most, they're 15 minutes. This is week 2, so I'm just going to click on to week 2. And it's going to start up in a second. It's about sales and merchandise and accounts receivable. And without it playing and conflicting with this, the sound on this lecture, it's a 14-minute and 45-second video that you can listen to over and over and over again. And it does explain the subject. It explains what you need to know in a very easy to understand fashion. But let's not forget another very important resource. And you know what that is? Yeah, that is your textbook. So I'm going to access it through week 1, the course home. You go to Vital Source ebook, open it up. Yes, I want a new window. It loads. And for this particular course, for a college accounting text, this course will cover chapter 6, 7, 8, and 9. And I'm going to click on chapter 7. And there's your chapter. Every single page of the chapter. And you can continue to go through the chapter, paging through the entire chapter. So that's your textbook. That's your other instructors, or if I'm not your instructor for this session and you're listening to this lecture, your instructor will be one of those also manning the phones and the Zoom in those subsequent periods in the live session schedule. So pop in, ask them questions. And there's no such thing as a stupid question because basically in accounting, you need to start somewhere. And in this situation, we're starting from Accounting 101. Last week, we just completed the closing entries, those 4 closing entries that will prepare the general ledger for the opening of the very first day of the new fiscal year. And this week is about accounts receivable. Next week is about accounts payable. And chapter 9, I believe, is about cash, handling cash, controls of cash, bank reconciliations, the entire cash handling subject. So this is your textbook. So you have your instructor's helps. You have your Student Success Center tutors. You have many people and many ways of getting help. So what's next on our agenda here? We just covered resources and help. Next would be the actual Chapter 7 instructional lecture. So I'm going to go to Chapter 7 lecture and start it from, oops, not that one. And start it from the beginning. And today so far we do not have anyone on this session, and I'm looking forward to having a chime sound when someone does show up. But until that, I'll just be talking to myself, assuming that I have a room full of people in front of me. So, college accounting. Accounting for sales and accounts receivable is all about today, Chapter 7. So, merchandise sales is Section 1. Section objectives is how do you record credit sales in a sales journal? And how do you post from the sales journal to the general ledger accounts? So what are the ways that you can have a sale? What are the ways you receive money from making a sale? There are 2 basic ways. One is you extend credit to someone, which means you don't get cash immediately at the point of sale. And the second way is to make a cash sale. Like if you're selling merchandise, when the customer takes the merchandise to you and gives you cash, that's a cash sale. If they come to you and say, can you put it on my account or credit card, but if they put it on the account, then you're going to expect payment. You're going to send them an invoice. They're going to walk away at that moment with your merchandise or with your service already rendered. And then you wait for the payment, whatever your payment terms are, 10, 15, 30 days. And then that's when you get your check in the mail. And then all transactions of that particular sale are complete. So today is recording credit sales in a sales journal. So let's see what that looks like. Journals that are used by a merchandising business. What is a merchandising business? Can you give me a couple examples of what a merchandising business is? A couple that come to mind are Walmart, the big box stores, Walmart, Costco, Target, all the big box stores, all the grocery stores are merchandising. They purchase from their wholesalers, they purchase merchandise already assembled, already for sale, and then they put it on their sale floor and they mark it up and then they sell it to the customer. So let's look at the journals that would be used by a merchandising business. There's a sales journal, a purchases journal, cash receipts, cash payments, and the general journal. So to date, through Accounting 101 and your first week in 102, you have only been involved with the general journal. We made journal entries into the general journal, and then we posted from the general journal to the general ledger. And from the general ledger, that's where we did the worksheet, adjusting entries that also went into the general journal, therefore the general ledger. And then after the adjusting journal entries, then we go forward to doing our financial statements, which are the balance sheet, income statement, statement of retained earnings. Those are the three that you actually have done in this class, and then there's a fourth one that is the statement of cash flows. So we have existed so far in your accounting curriculum in the general journal and the general ledger. And as you remember doing your homework in 101, there were several sales on credit, and you just had to go in for each sale and you would debit accounts receivable and credit fees income. Then you would debit accounts receivable and credit merchandise sales. You would debit account. So it was the same journal entry over and over and over and over again, and you would debit accounts receivable and credit sales, right? Well, we've devised now sales journals, and those are journals that are specialized to record only sales of merchandise on credit. Then we have one for purchases, which will only contain purchases of merchandise that you purchased on credit. And then we have cash receipts journal, and that's to record any cash that you any cash that you received from all sources, cash or check. Then the cash payments journal is to record all disbursements of cash, and that's cash or check. So these are specialized journals. These four are specialized journals, and the general journal will cover everything else that does not fit into one of the specialized journals. So if we have specialized journals, might not we have specialized ledgers? I think so. So here we have the general ledger, which will include all the asset accounts, liabilities, owner's equity, revenue and expense, and drawing accounts. They have all the accounts because those are the actual accounts in the general ledger that we have been using this entire curriculum. Now the specialized ledger is accounts receivable, and that will be the accounts for each and every one of your credit customers. If you ever call into your you receive a credit card statement, and then you call in to the 1-800 number because you have a question about some charge that's on your credit card bill. When you call that 800 number and you give them your account number, the people on the other side of the phone call have access only to the accounts receivable ledger. And when you tell them which account, that's only your page with only your transactions and all of the accounts receivable transactions of the company. It's the one page for your transactions only, so they know exactly what is hitting their account receivable or your credit card payable. That's a live example of what a accounts receivable ledger is. And likewise, we have an accounts payable ledger. that will list off every vendor we have and our transactions with them. So here is a sales journal. This is a great example of a sales journal. Now let's just go through the format first. We have the title, sales journal. We have page number. You know, we've used page numbers. And when this was a general journal, we would say, for posting references, we would say J1. But in this situation, we're going to say S1 when we post from here. Then the column headings, the date of the transaction, the sales slip number, the customer's name, and then these three columns are what's different. We have accounts receivable debit, sales taxes payable credit, and sales credit. Isn't this the same thing as a journal entry we did in Accounting 101? When it says we sold merchandise to Bob Smith for $100, you debited accounts receivable. You debited, where's my cursor? You debited accounts receivable by $110. You credited sales tax payable by 10, and you credited sales by 100. So whatever journal entry you made on the general journal in Accounting 101 for credit sales or sales on account, it's the same thing. This is how we're lining them up. So on January 3rd, we sold to Ann. We sold her something for $650 plus sales tax. So if we had gone into the general journal, we would have debited accounts receivable by $702, credited sales by $650, and credited accounts payable by $52. And then we would have gone to January 8th. That was Kathy Bell's, and we would do the same transaction in the general journal as a journal entry, and we would do the same, just like we used to, and then post to the ledger. When you only have 2, 4, 6, 8, 10 sales throughout the month, it doesn't get burdensome. You can do 10 journal entries very easily, and you can do 10 postings to the ledger very easily. But remember, each posting to the ledger is impacting 3 accounts. And each time you put money into an account, you have to recast your balance in the account. And each time you impact an account, you have to make sure that the debits equal credits from your posting. There's a lot of, the more activity that you have going through your the general ledger posting, the more activity you're posting, the higher chance for error. So, doesn't it make sense to kind of summarize them for the general ledger posting? Certainly. So, this is a journal that you just use throughout the month. And at the end of the month, you total them up. And this total is exactly what you put to the general ledger. You do not journalize in the general journal this transaction because you have the sales journal. But you do have to post directly from here, the sales journal. You post directly from here in the totals line directly into the general ledger. I think there's an example. So with a sales journal, it's not necessary to post each credit sales individually to the general ledger accounts. Okay. Instead, summary postings are made at the end of the month after the transaction amount columns of the sales journal are totaled. So here's an example. We have up here at the top, this is a sales journal. the same one that we were looking at, Ann Ang, Kathy Ball, and at the 31st, we sold to Ann again, and we have the totals. Down here, we have the accounts receivable ledger page from our general ledger. So we're going to take the total. This is our journal entry instructions. Go to accounts receivable and debit the account by $6,156. Go to the accounts receivable account in the general ledger and debit the account by $6,156. Cast a new balance. $25.92 plus $61.56 equals $87.48. So debit the $61.56, calculate the new balance. What we do in the posting reference, it's page one of the sales journal. So while we're still in the general ledger page, we put into the posting reference S1 to signify sales journal page 1, because these previous transactions came directly from the general journal page 2. So this is the sales journal page 1, and to complete the cycle for the posting references, the account number to which we actually put the $6,150 is account 111, and we put 111 in parentheses underneath the total of the accounts receivable column, indicating that the $6,156 went directly to account number 111 in our general ledger. And the same thing happens with the accounts payable, sales tax payable account and the sales account. And now we have these cute little arrows. Okay, so step 1 is you pass the date down to the date. Step 2, the page number goes down to the page, the posting reference S1. Step 3, you debit the total because it tells you up here accounts receivable debit. This is accounts receivable. Here we're going to put a debit. Step 4 is to calculate the total balance now. And step 5 is to put the account number in as the posting reference underneath the column of the sales journal in parentheses, indicating account number that the $6,156 went to. Okay? So the advantages of a sales journal. It saves time and effort and recording space. It makes journalizing and posting more efficient because you can see it, right? There were 10 sales here. We have 10 sales. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. There are 10 sales here. And if we use the general journal and the general ledger, that would be 10 times 3 or 30 postings to 30 separate postings to 3 accounts, but yet you had 30 postings and calculations of 30 balances and indications of these posting references on both sides. That's a lot of work. So, and again, this is a small company with only 10 sales. What if you had 10,000 sales? That would become unwieldy. So let's go to the advantages again. And this requires only 3 summary postings to the general ledger at the end of the month. We just showed you that. It allows for division of work. And it improves the audit trail. So now, section 2 is accounts receivable, and step 3 is posting from the sales journal to the customer's account in the accounts receivable subsidiary ledger. And then we record sales returns and allowances in the general journal. And then we post the sales returns and allowances. And lastly, we're going to prepare a schedule of accounts receivable, which is simply a listing of everyone who owes you money and how much they owe you with a total. Excuse me, I wanted to have a drink of coffee. Okay, so here's the accounts receivable ledger. Think of it as the general ledger where you post details. Now in the general ledger, we're no longer posting details, are we? We're just posting the total of activity for the entire month in one summary total. The detail has to be somewhere. So if the detail is going to be in the accounts receivable ledger, because elsewise we will not know who owes us money and what their balances are. So to fix that, we have an accounts receivable, and sometimes, forgive me, but I'm going to call it a detailed or a subsidiary ledger. It's an accounts receivable ledger that has all the details in it that's important for the business to operate. So Ann, this is her account, this is her address, and all of this will be the transactions that happen to her account. There's a date column, a column for description, posting reference, is something debited or credited to her account, and a balance. So here's what some of the postings would look like in 2013, January 1, her balance is $432. We have to start somewhere, right? So January 3rd, remember that sales step number? Remember here we posted the total of $6,156 to the general ledger. However, of that $6,156, she owes us $702 because of her January 3rd transaction, and that $702 is the total of the sales plus the sales tax. So she owes us $702. Now, let me go forward to the page we were. So this is January 3rd, sales slip 1101. We're going to debit Ann's account receivable ledger account by $702. And then her detail is her balance of $432, which is a debit balance. Why is it a debit balance? What type of an account is accounts receivable? Yes, it's an asset account. And asset accounts have normal balances of what? Debit or credit. Accounts receivable have a normal balance of a debit. So we have a balance of a debit. We have a debit applied to her account of $702. So a debit plus more debit will get you a larger number. $1,134 is the balance, which is $432, the balance before the transaction, and the transaction itself adds to a total of $1,134. Okay, so the accounts receivable ledger has three money columns, a debit, credit, and a balance. The balance is presumed to contain debit amounts because it's an accounts receivable. And we just went through that accounts receivable are assets, and assets have debit balances normally. So we're going to post from the sales journal to the customer's accounts in the accounts receivable subsidiary ledger. So each credit sale recorded in the sales journal is posted to the appropriate customer's account in the accounts receivable subsidiary ledger. So here's the sales journal, and here's Ann. Again, This is January 3rd. We draw down the date to the accounts receivable subsidiary ledger. The date comes down. The sales slip number is part of the description, sales slip number. So no matter what, then someone can go back to the sales slip itself to answer any questions from the company perspective or questions asked to the company by Anne. What did I buy then? And they'll be able to go to the sales slip itself because they have a sales slip number. That's 1, 2, 3. Remember the sales journal has an S, so it'd be S1 to indicate the page on the sales journal. So that's the posting reference. Then we're going to accounts receivable debit, and this is a 702. This is Anne's subsidiary account. So the 702 that belongs to Anne only gets put down here as a debit. Then you calculate the balance. And the last thing is in the sales journal, you put a check mark that the posting reference occurred to Anne's account. So a sale is entered into the accounting records when the goods are sold or the service is provided. If something's wrong with the goods or services, the firm may allow a sales return or give a sales allowance. Let's talk about that a little bit. At the end, during the holiday season, I know some people, I'm not one of them, but I know some people who just go and buy merchandise for gifts, and they hope that, they hold them up to themselves and see if, and try to do the sizing, and they always get the wrong size. The person doesn't like the right color, and what happens December 26th? All this merchandise gets returned back to the store. So how do they account for that? They account for that as a sales return. And a sales allowance. Imagine yourself finding something in a store that you really want to buy, but let's say it's that perfect dress or that perfect shirt, the perfect color, the perfect fit, but there's a little mark on it, or the button needs to be sewn back on because it's getting kind of loose. Something is not perfect about it. Do you want to pay full price for it? Many people do not. So they will go to the assistant manager or the manager and say, I want to buy this blouse or this shirt or this dress or whatever it is, but look, it's got a little mark on it, or the button's about to come off, or it's missing a button. So can you take something off and I'll buy it? If you don't take anything off, then I'm sorry, you're never going to be selling this because it's got a mark on it and it's got a missing button, or a button that's going to be soon missing because it's being held on by one thread. And then when they give you a discount price, that discount is a sales allowance. Now, why do you think that sales returns and sales allowances are separate accounts in the general ledger? Well, more importantly, why do you think that sales returns and sales allowances are tracked by management wanting to have those in separate accounts in the general ledger? Okay, the reason is they want to see, number one, how dissatisfied your customers are. When a customer buys something and then returns it, there's a dissatisfaction. And we want happy, satisfied customers, but sales returns are an indication of perhaps customer dissatisfaction. Either the color was wrong, the catalog misrepresented it, the sizing was too big, too small, the quality was bad, whatever. It was a sales return. So that's an indication of potential dissatisfied customers. A sales allowance will also be an indication, possibly, of faulty merchandise quality dropping by your vendor. So with both of those, armed with both of those accounts as documentation, you can negotiate either give us higher quality or a price reduction, or we're going to go to another vendor and take our business elsewhere. And then you would have the your account of your purchases with that particular vendor. You'd have your account with you too that shows them how much your sales, how much you contribute to their sales, which is also their commission. So with those bits of information in your hands, you have some ammunition to get either better discount rates, lower prices, or better treatment and higher quality. Okay, so that's why we're doing sales returns and allowances separately. So those are posted directly to the general journal. And basically, Linda Carter returned her product, and we accepted a return of defective merchandise. And a journal entry will be just a backward, reverse journal entry of the sale. The sale was a debit to accounts receivable, credit to sales, and credit to sales taxes payable. This will be a credit to accounts receivable, reducing accounts receivable. It'll be a debit to sales returns and allowances, which is a contra sale account, but is still considered part of the sales groups of accounts. A debit would reduce total net sales, and sales taxes payable would be a debit reducing the amount that you owe to the state for sales tax. So this entry is just the reverse of the sales entry, except instead of using the sales account, you use the sales returns and allowances account. And again, account 111 indicates that the amount was posted to the account receivable account in the general ledger, because you also had to not only put it to accounts receivable in the general ledger, you have to put it to Linda Carter's specific account in the accounts receivable subsidiary ledger, because she purchased it and then she returned it. So the sales journal, this is the accounts receivable subsidiary ledger for Linda. The sales journal, page 1, had her sale on there, which created an accounts receivable of $486. And then this credit memo of $486 is from the general journal, so this is J1, reducing the amount that Linda Carter owes, and the balance drops back to $54, the amount she owed before she purchased and returned the purchase that she actually made. Okay, so how does this look on the income statement now? In Accounting 101, you had sales, and then you went right into cost of goods sold or expenses to come down to net income. Well, with this chapter, we're expanding the revenue section so that we have sales, 25,700, less sales returns and allowances, 600, leaving you net sales of 25,100. So 25,007 minus 600 will get you 25,100. So this is how the sales section quite often looks for a company. Sales less sales returns and allowances equals net sales. And sometimes it's called revenue. Here the category is titled revenue, and then we're dealing with sales. Sales and revenue are synonymous. They mean the same thing. If you want to get particular about it, sales would be more appropriate for a merchandising company, and revenue would be more appropriate for a service type of a company. But in the end of the month, at the end of the day, revenue is how you earn your money, and so sales is how you earn your money. So they're pretty much used interchangeably. But 25,007 is the gross sales, is all the sales that you've made, regardless of whether they will be subsequently returned. The returns and allowances are in the second line called sales returns and allowances, coming down to net sales. So, max out sporting goods, schedule of accounts receivable. So you go to the accounts receivable subsidiary ledger and go to each and every one of your customers, and you just list off the balance in each account. And that is your schedule of accounts receivable. You go to the accounts receivable subsidiary ledger and pull the balance, the ending balance from each account, and put it into a 2-column analysis. One column, the first column is the customer's name. Second column is how much they owe you. And you come up to a total. So this is what we have here. So this $6,615 is the total of what Ann owes you and these other folks and Fred Rue, $440. All of these folks owe you a total of $6,615. Now that should be 100% to the penny the same amount that is in your accounts receivable general ledger account, $6,615. Remember, the general ledger account got the subtotal, the total of the sales journal posted to it. It didn't get the individual piece parts posted to it. It got the total. So this is the, I guess you could say, the control sheet, because it's got the general journals as well as the summary, the totals of from the sales journal, and then your credits. This is from cash receipts journal, page 1. You don't know cash receipts yet, but this is a cash that you receive, and this becomes your balance. This balance in your general ledger account has to equal, equal the total of your schedule of accounts receivable. If it's not, then something's wrong. You may want to take the difference between the two and see if that number looks familiar. If that number does not look familiar and you divide that difference by 9 and it comes out to an even number, i.e. a number that does not have any decimal points, if it comes out to a clean number without any decimals, then you may have transposed a number, put the same number in the wrong spot when you're posting. But somehow you have to find out where you went wrong. So, accounts, okay, section 3, special topics in merchandising. compute trade discounts, report credit card sales in appropriate journals, prepare sales taxes return. So, what are the advantages of credit sales? The volume of both sales and profits will increase if buyers are given a period of a month or more to pay the goods and services that they purchase. So you sell them the merchandise, they walk off with it. They use it in their business or in their personal life. They're supposed to pay you in 30 days. That encouraged them to buy, so you have increased sales. But there's a disadvantage. Sales on credit will lead to increases in profit only if each customer completes a transaction by actually paying for the goods or services purchased. And that is a concern, certainly. And if payment is not received, the expected profits become actual losses, and the purpose for granting the credit is defeated, and it has hurt you because you have performed the service, you have paid for your employees to work performing the service, or you have ordered the merchandise from your vendor, paid the vendor for the merchandise that the customer walked off with, and the customer didn't pay you. So it's just not a paper transaction. You're actually out cold hard cash when someone doesn't pay. So these are the advantages and disadvantages of credit sales. And therefore, businesses need to closely analyze a customer's ability to pay before granting credit. And I do believe that is the crux, that last statement is the crux of our discussion for week 2 in Accounting 101, in Accounting 102. We talk about how to go about granting credit to folks. Okay, so hopefully there's no questions, because I don't, still I'm talking to myself because there's no one on the line today. And I'm going to then go to our next part of the agenda, which is, what is week 2 homework? What is it? What is expected? And how do I get started? So I'm going to reduce that, and I'm going to actually go, this is your course. 102, come on. I'm going to get in it just like you get in it. Week 2. And week 2 assignment. And week 2 template. So I'm just going to open the template up. Bear with me a couple seconds. Okay. So, as part of your New Year's resolution, you increase the success of the business. That's what you resolve. So you decide to offer products in addition to services. So we have this assignment template to complete this week's work. And additionally, you've also decided to expand your client list by offering credit terms. You've learned the importance of properly accounting for your receivables by using the accounts receivable subsidiary ledgers. Before taking on new clients, you need to create an accounts receivable subsidiary ledger account for your existing credit client, Speedy Freight. The terms originally offered were net 30, which is he has 30 days to pay you, but at 30 days, he owes you the entire amount. There's no discount. Speedy Freight's address is given here, and to keep things simple, their existing balance as of January 1 has already been entered into the account receivable subsidiary ledger account. Now we have the accounts receivable subsidy ledger. We have targeted marketing to some local companies yielded some new clients. Great news. But after careful check of the ability to pay and payment history with vendors, the following clients are now seeking your services: Pinpoint Marketing, Able Landscape and Design, and Smith Jones Builders. And these are their addresses followed by their terms. Again, their terms are in diagonal 30, which means net 30. Net 30, net 30. And now you have transactions. So January 10th, sell a new desktop computer to Able Landscape for $2,200 plus 7% sales tax on account issuing sales tax. So you have this information of transactions, and now you're told to make sure to record each transaction to the appropriate journal and make any necessary posts to the subsidiary ledger daily. At the end of the month, properly total the sales and purchases journal columns and post to the general ledger. Remember, any entries to the general journal are posted immediately. Then you create a schedule for accounts receivable. So let's take a look to see what this looks like. And let me just give me 2 seconds here. I want to see. This is week 2. Week 2. Okay. This is what your homework template looks like unfilled out. You have sales journals. That's where you put your sales slips and accounts receivable debit, sales tax payable. So this is the first thing that we showed you today, a general journal for some. I think that you have some sales returns, sales allowances, and then you have the ledgers, which on one side is the general ledger, which has the accounts receivable account, sales tax payable account, and sales returns and allowances account. And on the right, you have the accounts receivable ledger. For Speedy Freight, these are the actual people that owe you. Speedy Freight, Pinpoint Marketing, Able Landscaping, and there's another one. And if they already have a balance, it's already in there. And here's Smith & Jones. They're a new customer also. And then after you get the whole thing done, then here's a schedule of accounts receivable. And then the big question is, does this total right here match the accounts receivable account in the general ledger? So does this match this balance right here? And you say yes or no. I don't want to just leave it here. I want to kind of show you this is not your example. This is your exact homework, but the numbers are different. So this is how it should look after you're done. But this is not your solution. Again, this is not your answers, but this is how it should work and how it should look. You have sales journals by date, by sales slips numbers, the customer's account debited. So here, accounts receivable debits, accounts payable credits, and total sales credit. So sales of $2,200 plus $200 for sales tax, the person owes you $2,400. That's how this gets populated. Then you total them, and the total here is $8,900, $730, and $8,170. Now, what do we do with this? The numbers I highlight in blue. Well, they do not go to the general journal because the sales journal replaces it. And which ledger does it go to? It doesn't go to the general, the totals go to the general ledger. So let's go back to the journal. The totals are accounts receivable debit $8,900. Go to the ledger, go to the general ledger, accounts receivable January 31st, S1 for sales journal page 1. You debit accounts receivable by $8,900. Account 111, remember that? Because now you're going to put account 111 below it, because this indicates the account that this total went to. Then if you look at sales taxes payable, $730, and sales credit, $8,170, you will see here's a $730 credit right there, and the $8,170 credit. Remember, these are total of all the transactions. So here's your sales credit, your credit to accounts, sales taxes payable, and here's your debit to accounts receivable. And this is the general ledger. Now, we can't stop there, because this level of detail needs to go somewhere. So that level of detail, let's say Able Landscaping 2,400. Able Landscaping, they get their account debited because this is accounts receivable ledger, right? Accounts receivable ledger. Accounts receivable, when it gets increased as an asset, it has a debit balance. So Able Landscaping will be increased by $2,400 because sales step 103 on January 10th. That came from January 10th, sales step 103, $2,400. Then you want to do the same thing for Speedy Freight and Pinpoint Marketing. $3,500 for Speedy Freight. Here's your $3,500 for Speedy Freight, and the 2 transactions for Pinpoint Marketing. Again, you put the dates, sales slip with a sales slip number, S1 for sales journal, page 1, and this is the detail of this particular customer's transaction. In the general ledger, this is the total of all of these customers' transactions. Then, when you get done and all the balances are made, $4,365 here gets listed here, $4,360. So every one of these accounts up here in the accounts receivable ledger, you list their name, and then you list the amount that they owe you at the end of the month. And then you come up to the subtotal, $11,265. And totals, the total accounts receivable ledger account, $11,265. You do a celebration dance, and you say yes to that question. Does the total, this total, match the current balance in the general ledger? The general ledger, $11,265. You can answer yes to that question, and then save this document, save this Excel spreadsheet, and upload it as usual for your homework. Now, I want to give you a refresher from Accounting 101 on debits and credits and trying to get the balances correct. Accounts receivable is an asset. An asset has a debit balance. So the accounts receivable balance for Speedy Freight, so this would be a debit. And that's your balance. On the 14th, you put a debit to the account because he bought more product. He now owes you more money. So $1,400 debit plus $3,500 debit would get you $4,900 revised balance of $4,900 debit. Because you start with $1,400 and he bought an additional $3,500, which now he owes us $4,900. And you will find that he's going to have a return or something on the 23rd for $535, and you take the $4,900, which is a debit balance, you apply a credit against a debit balance, and that reduces it. So $4,900 minus $535 will get you a debit balance of $4,365. So I hope this has helped. This will be posted by your faculty, by your instructor. It will be posted for your instructional lecture. And I'll see you all next week, same place, same time. And don't forget your support system. The mega lectures, your textbook, your instructor, this instructional lecture, your tutors, through the Student Support Center, and the other sessions in the live sessions that are hosted by other faculty members teaching this exact same course in this exact same mod, waiting on the phone and on Zoom to help you. So that is an awesome team to have to support you with any question that you have about the homework. So take advantage of it, and I'll see you, and you'll hear my voice next week, same place, same time. Bye.